Welcome to Tax Talk. We've been talking about comprehensive planning, and one that goes missed a lot is capital gains. And Jerry Masisak, our CPA, the tax guy, joining us today once again for another great segment here on Tax Talk. Let's talk about capital gains. This is a big one, Jerry, that's overlooked quite frequently. But I want to talk a little bit about, before I pitch it to you here, Jerry, I want to talk about types of money, tax status of money, if you will. A lot of people think, okay, when does capital gains come into play? Well, it's mainly on non-qualified money. This is brokerage accounts, taxable accounts, they're after-tax accounts where the pre-tax or qualified money, IRA, 401k, it doesn't matter how much of a gain you have, those accounts are taxed as ordinary income. Jerry, let's jump into this thing if we could, and let's start talking about what do we see and what is capital gains?
So capital gains, and there are two different types, Bill. There's a short term and a long term. Each one of them has their pluses and minuses, but when it's all said and done, there's opportunities in there that you could take advantage of. Tax rates and length of time.
Yeah, perfect. So what is that length of time when you think about it?
So for short-term capital gain is when you hold it 1 year or less. Long-term is when you hold it for over 1 year.
So what rate would somebody pay depending on that situation?
So on a short term, they're going to pay at ordinary income tax rates, which would be anywhere between 10% and 37%. Long term is going to be between 0% and 20%, depending on your income bracket.
And this is one that we'll talk about, gets missed a lot. People have an opportunity to pay 0%, but they end up not because they're just not paying attention to it.
By the time they find out about it, it's too late.
Absolutely. So when you think about planning opportunities, one big one is obviously what we were just talking about, beneficial tax rates.
Correct. So as you alluded to, Bill, there's an opportunity to have a 0% tax rate on a long-term capital gain, assuming that you're within the bracket.
So the next one is effective use of capital loss carryover. And I've seen this in my 26 years. We've seen this, and you've seen this probably 1,000,000 times, and I've only seen it 1,000. Right?
Absolutely. So, using those capital losses to your advantage when you're sitting on them, if you have gains and you have unrealized gains, that's an opportunity to take advantage of those losses you have carrying forward.
How about net investment tax? How does that work?
Net investment tax is one of those hidden type taxes that once your income gets over a certain threshold, depending on filing status, you're subject to additional tax. So that capital gain now isn't just costing you your tax rate, it's costing you 3.8% more than your tax rate.
And mutual funds, if you own a mutual fund, one of the most ineffective tax efficient vehicles out there today. Bottom line, it's time to get a tax plan review. It's simple to get. Give Jerry and I a call. It's easy, 800-878-6223. Ask for it by name, tax plan review, or visit us online, wasmithfinancial.com.